name a business that has been ruined because it was over downsized. I cannot think of a single one, but if you ask me to name businesses that were half ruined or ruined by bloat, I mean, I could just rattle off name after name after name. It's gotten fashionable to assume that downsizing is wrong. Well, it may have been wrong to let the business get so fat that it eventually had to downsize. But if you've got way more people than are needed in the business, I see no social benefit in having people sit around half employed or unemployed.
And you're very likely to compete against some guy at some point who doesn't have more people around than needed in the business too. But it doesn't change. For the people involved, they've got real problems. And
Warren, can you name one that has been ruined by over downsizing? There must be one, but
well, it's like Eisenhower said about Nixon. Give me a week and I'll come up with something. How about Zone 6? Well, we know more about the security business than we knew 10 years ago, and it is a tough business to manage. There's a lot of money made in the business, and then throughout Wall Street, I'm talking about. There's very big sums of money made, and then the question is, how does it get divided up between the institution and the people there? And you get to this question. I've often used the analogy of, would you rather, if you're an investor and you get a chance to buy the Mayo Clinic, that is one sort of an investment. And if you get a chance to buy the local brain surgeon, that's another one. You buy the local brain surgeon and his practice for X millions of dollars, and the next day, what do you own? And if you're buying the local brain surgeon, you would not pay any real multiple of earnings because he's going to have this revelation several days later that it's really him and not you there with your little stock certificate that's producing the earnings, and it's his reputation. And he doesn't care. Can you imagine Berkshire Hathaway advertising brain surgery? How much business we would do. So he owns the business even though you've got the stock certificate. Now, if you go to the Mayo Clinic, no one can name the name of anybody at the Mayo Clinic unless you live within 10 miles of Rochester. And there the institution has the power. Now, it has to keep quality up and do all the things that an institution has to do. But whoever owns the Mayo Clinic has an asset that is independent of the attitude of any one person in the place the next day. Wall Street has a mix of both, and there's some businesses that are more where the value resides more in the institution, and there's some where the value resides more in the individuals. We've got a couple of sensational people running Solomon, and they wrestle with this problem as they go along, and they seem to be wrestling considerably more successfully currently than was the case close to a year ago. But it is not an easy business to run, and it's not an easy business to predict unless you have a business that's very institutional in character, and there aren't many of those in Wall Street. In general terms, unless you find the prices of a great company really offensive, if you feel you've identified it, and by definition a great company is one that's going to remain great for 30 years. If it's going to be a great company for 3 years, it ain't a great company. I mean, so you really want to go along with the idea of. So you really want to go along with the idea of feel bad leaving the money on the trip, and you come back and it's going to be a terribly strong company. I think it's better just to own them. I mean, we could attempt to buy and sell some of the things that we own that we think are fine businesses, but they're too hard to find. I mean, we found See's Candy in 1972, where we find here and there we get the opportunity to do something, but they're too hard to find. So to sit there and hope that you buy them in the throes of some panic, that you sort of take the attitude of a mortician, waiting for a flu epidemic or something. I mean, I'm not sure I'm not sure will be a great technique. I mean, it may be great if you inherit it. Paul Getty inherited the money at the bottom in 32. I mean, he didn't inherit it exactly. He talked his mother out of it, but yeah. It's true, actually.
Close enough.
Yeah, close enough, right? But he benefited enormously by having access to a lot of cash in the early 30s that he didn't have access to in the late 20s, and so you can get some accidents like that. But that's a lot to count on, and if you start with the Dow at X and you think it's too high, when it goes to 90% of X, do you buy? Well, if it does and it goes to 50% of X, it gets you never get the benefit of those extremes anyway, unless you just come into some accidental sum of money at some time. So I think the main thing to do is find wonderful businesses. Is Phil Carre here? We got the world. Yeah, there's the hero of investing. Phil, would you stand up? Phil is 99. He wrote a book on investing in 1924. Phil has done awfully well by finding businesses he likes and sticking with them and not worrying too much about what they do day to day. There's going to be I think there's going to be an article in the Wall Street Journal about Phil on May 28th, and I advise you all to read it. You'll probably learn a lot more with him by coming to this meeting. But it's that approach of buying businesses. I mean, let's just say there was no stock market, and the owner of the best business in whatever your hometown is came to you and said, "Look, my brother just died, and he owned 20% of the business, and I want somebody to go in with me to buy that 20%. And the price looks a little high, maybe, but this is what I think I can get for it. Do you want to buy in?" I think if you like the business and you like the person who's coming to you and the price sounds reasonable, and you really know the business, I think probably the thing to do is to take it and don't worry about how it's quoted. It won't be quoted tomorrow or next week or next month. I think people's investment would be more intelligent if stocks were quoted about once a year, but it isn't going to happen that way. So, and if you happen to come into some added money at some time when something dramatic has happened, I mean, we did well back in 1964 because American Express ran into a crook. We did well in 1976 because Geico auditors didn't know what the loss reserve should have been the previous couple of years. So we've had our share of flu epidemics, but you don't want to spend your life waiting around for them.